me now welcome on board Manish Sonthalia and find out what he's making of the market. Manish, hi, great to have you on the show. And finally, after that 14-month long break, we've made it to a record high and starting off well as well in the green this morning. I guess the GDP cheer rubbing off on the equity markets. But Manish, what next now?
So yeah, the markets have actually crossed the previous highs of 26,277 seen in September 24. So after 14 months, that's correct. But it does not really feel like that markets have hit a new high with, there's some distance where the mid cap stocks have still to reach, and there's some distance where the small cap index is still to reach the all-time highs. So there's a lot of pain in the broader markets. Optically things look very bright. The banking stocks, etc. These are heavyweights in the index. They are doing all right. But, there is a lot to catch up as far as the broader markets are concerned. As far as the earnings trajectory is concerned, things are chugging along well. And obviously, I believe that next year earnings growth is going to be around 15-16%. 2-year CAGR on 26 and 27 is going to be 13-14%. We should be headed higher on Nifty 50 per se to the extent of 15-16% in the next 12 months. And I think the real cheer in the markets would come when there is some green, some deep green that is seen in the mid cap index and the small cap index.
But Manish, when do you foresee that revival to come in? When it will be a more broad and across the board move by the markets and mid and small caps as well will participate?
No, so what is happening is basically money from the secondary markets is moving to the primary markets. The issuances are just too much. Even for the month of December, we are looking at a pipeline of 40,000 odd crores. So, the small cap segment is a very large universe. You have a classification of 1 to 100 in large caps. So whatever SIP flows come in the large caps will get deployed only in the top 100 stocks by and large. On the mid cap, it is basically 101 to 250. So another 150 stocks will see the flows in the mid cap segment. But the small cap segment is a very large segment. So there's a problem of liquidity. Liquidity is tight in the system and it's a very large universe. That is why it is stagnant. It's not to do so much with the earnings or the valuation. Valuations have come down significantly for the mid and the small caps per se. But I think this whole thing will get better. The sentiments as well as the prices in the border markets will only get better once liquidity in the system revives or there's not too much of over bunching of IPOs that happen on a monthly basis.
Manish, you are penciling in a high earnings growth for the Nifty going into the next financial year. Which are the sectors which are going to drive this earnings growth?
Rate sensitives. Rate sensitives are in a very sweet spot. Anything to do with interest rates, whether it be banks, NBFCs, insurance, you have real estate, automobiles. These are going to be the front runners when it comes to lifting the Nifty 50 to more highs coming into the future, because apart from whatever government is doing to help the growth, the interest rates getting lower in the system, maybe not this December, but in the next policy meet, you could be headed even lower, because India doesn't have a problem of inflation, whether it be the CPI or the WPI. CPI is 2%, WPI is negative. So I think rate sensitives are going to be the massive outperformers going into the next one.
Manish, you believe this time on Friday we might be looking at a pause, that continued pause, because on 1st October we did see a pause coming in.
I mean, see, logically, you should see that the rate cut should be there. But given the fact that the currency is appreciating so badly, and given the fact that maybe you will see, further rate cuts in India only after announcements of further rate cuts in the US happen, because you can't keep too low a spread between the US rates and the Indian rates. So maybe this time around you could see a pause. There could also be a probability of a 25 basis point cut. But next time around the next credit policy meet, you could see a definite 25 basis point cut.
Are you looking closely at some of the macro, numbers which are coming in, especially with respect to tax collection, which has been subdued for now? The nominal GDP is around 8.7% for Q2, and that's also, bringing in some kind of concerns as well.
Yeah, I think the problem for the Indian economy is not the real GDP growth rate, but the nominal GDP growth rate. Because inflation, I mean, achieving a 10% nominal GDP growth is somewhat of a challenge in the current environment. And I think government is doing its bit in terms of helping the demand side of things, particularly when it comes to consumption through income tax cuts or GST cuts or even the eighth pay commission recommendation. These would all come about in the next. It's already implemented, and you'll get the recommendations in the next 18 months. But I think, yeah, tax collections has not been that great, but I think they are on course to meet their, full year targets, because if the nominal GDP growth is 10%, your receipts can't be more than 10-11%. That's for sure. So yeah, I think third quarter and the fourth quarter, you'd see heightened economic activity, and that should result in better receipt collections for the government.
So, as an investor, Manish, what do you do? Do you ignore what's happening in the primary market? And is this the time to base build your portfolio within small and mid caps? Because by the time money moves back, you won't get these prices too.
Absolutely. I think, what do you do with the new money that is coming in, and how do you deal with this flurry of IPOs? See, all the IPOs are not bad, and neither are they at very elevated valuations. So it is a pick and choose between the primary and the secondary markets. Many of the IPOs are very, very overpriced, and it's basically a listing game. Those should be avoided at all costs. Some are exorbitantly overvalued. They should be avoided at all costs. But I think a blend of both the primary and the secondary market is where you should look at. I think the main sectors to look at is basically your rate sensitives, capital markets, contra play on IT, because India is an anti-AI play, and overall IT spends in India, including the GCCs, are not going to see too much of a slowdown even in the current AI environment. So even IT is looking good. These are some of the spaces which, according to me, is okay. And keep some money in the portfolio for bullion, 10 to 15%, because of the woes of the US dollar. That should also be a part of one's portfolio. But we have got to keep a tab on valuations, and I would believe that valuations are the only case of worry as far as the stocks which are listed in the secondary markets or whatever is available. And I would reckon that if you are having somewhat of a bold heart and take a call on the broader markets, mid and small caps, from the next 3 to 5 year point of view, there cannot be a better time than the current situation. Stocks have already corrected 20-25%, more than 60-70% of the stocks have already corrected 20-25%. Maybe give it another 10%, but the upside is similar to what we saw as the upside in 2025 when we would have bought it in 2020. After the COVID, when there's so much of pessimism around the mid and the small cap, guys who have actually bought in and around those times have made a lot of money. Similarly, when you look out into 2028 or 2030, and you look back into 2025, this would have seemed a very good opportunity to build, quality stocks at very reasonable valuation.
Okay, Manish, great to have you on the show. Thanks as always for your time.
Thank you.